Hi, I'm Mark Mancini with VRB Outstanding. This week's episode is part three, or what I like to call the Q&A with your favorite CPA, Ron Kelm. Stay tuned. So welcome back this week. Again, we've got Ron Kelm, and he's our CPA who's provided some great insight in the last two episodes, but evidently it sparked a lot of questions. We had a bunch of questions come in via email and through our course and some of our students. And Ron, we're going to hit you up with some questions. But first, I want to remind the people a little bit about you and how you got started with short-term rentals and real estate.
Well, I've been a tax CPA for 35 years. I've had a number of clients over the years with real estate investments, and I went out on my own during 2020, and I've always loved real estate. I decided to get my real estate license this year, set up a real estate firm, so I can do it all. I can do your taxes. I can help you find a house. I can sell your house. I've set up the real estate company as the Abides team. It's with my wife Bonnie and I. And if you look at me, the caricature, but actually my wife came up with the name because we're big fans of The Big Lebowski. So if you know the movie where Jeff Bridges was the main character, he looked a little bit like me. And you're not gonna believe it, but as short as 15 months ago, my hair looked a lot like Mark's. But when you work for yourself, you could do what you want. So the inner dude came out of me, and this is what I look like today. But I'm still professional. I still know all the same rules.
Ron, just so people know and we're clear, back about 30 years ago, I had Bon Jovi type long, curly, highlighted hair back in the 80s and 90s when, that was the thing. But that's for another video. but but great. So and Ron comes, like I said, a long line of tax experience, but also short-term renting. In fact, for those of you who don't know, I've been involved with short-term rentals 11 years now. A lot of these people are experts in doing short-term rentals for a couple of years. Sure, they've scaled up quickly, but they don't know all the nuances with surviving the number one expense everyone has in their lifetime, which is what, Ron?
Your house.
Taxes.
That's right.
So taxes are your biggest expense. Your house shouldn't be an expense; it should be an asset, right? But
Yeah.
but yeah, it's taxes and CPAs. Their job is to practice what I like to call tax avoidance, not tax evasion. Right? One's legal, one's illegal. And you've
Yeah.
got guys like Jeff Bezos and Trump and Elon Musk, who these guys have all these loopholes. They're not paying taxes. So we have questions from most of them from our students in the course who wanted to know because they want to pay less taxes. The very first question is one of the early things we go over in my course. Ron, this is a great one for you. The benefits of buying a home as a short-term rental instead of a condo, which is very popular here in the Myrtle Beach area.
Well, the biggest problem with condos is their HOA fees, and they're often smaller. So the condo, you're when I do a cash flow analysis for a condo, I think that condos are good for people that truly are wanting to purchase their eventual retirement home, or they're not that concerned about making money with their investment. They just want to kind of break even. Because if they didn't short-term rent it, they would have all these expenses for having this condo in the resort area that they like to vacation. So now you STR it, you're gonna, somebody else is helping you offset those expenses. But the HOA fees typically are excessive in condominiums, and they destroy the cash flows. So long-term, so a house is a much better option, particularly a house that can sleep eight or more, because then you're going to get families. The other contrast in that scenario is condos with only one or two bedrooms typically attract couples who are often just going to be there for a weekend stay. You know, some people will, depending on the exact location, some people might stick around for a week. But
Sure.
my wife and I, we just spent the weekend up in Helen, Georgia, and we rented Friday through Monday, which was 4 days, which is kind of long for a condo, you know. And this was um, but that's typical. And with a house, when you get the whole family involved, they're typically staying for at least a week.
And also too, financing. I know there's some around here called condo-tels where financing is a little bit different, where you have to get a mortgage, but then there's a balloon payment at the end, and you have to put more money, like 20% down. I know there's difficulties with that. And the other thing too, that's always scared me from condos are unexpected assessments, right?
Yeah.
So
Yeah, I mean, if you have a house and it happens to be in an association, your homeowners association fee is only going to cover you know, the general maintenance and so forth of the premises, but your home is still, you know, your property. You decide when you need to replace the roof or when you need to, you know, do anything else. You're not beholden to a HOA that decides that the windows need to be updated to better survive a hurricane or something to that effect.
in fact, my sister's got a condo in Hallandale Beach. Now she doesn't do short-term rentals. This is her home, but they actually had a $5,000 assessment because of the concrete with cracks in there and so forth, because of that condo that fell apart there in South Florida about a year ago or so. And so there are some sudden expenses that happen with condos that people oftentimes aren't expected with. And also, have you ever seen a condo HOA board where there was a financial solvency issues where all of a sudden maybe somebody took money or misappropriated funds or made a bad purchase and now they're negative and they have to ask for increased HOA fees, right?
Right. Or they just did a poor job of determining what the repairs would be 10 years down the road. So the people that or owned it from day one, you know, got off because the assessment was too low. So they have reserve issues.
And I don't mean to beat up condos, so we'll change the topic. And we're not beating them up. It's just you have to run the numbers. That's one of the things Run helps people out with is running the numbers to make sure that everything makes sense, especially in this economy where people may not be spending as much, so they're a little more conscious too about things. So we want to make sure those numbers are conservative, that when you buy something, you're not overextending it. But as we discussed this and even in the previous episode, thing I always love about short-term rentals is that you get to take a vacation. So we're going to talk about deductions, Ron. Um, we were just in the Keys for a period of time. Okay. Now I know there's some things to discuss you want to touch on with this question that came in about how long you can use your short-term rental for. And if I'm going down to make repairs, remember, I've got a big pickup truck. It consumes lots of gas. If I'm driving 13 hours, is that that gas tax deductible, and so forth? So, what are some of these deductions with visiting your home and the time, the length of time you can use your short-term rental, et cetera?
Yeah, there's a myriad of options here, dependent upon the facts of the situation. Now, in your case, you are fully working in this short-term rental field. It's your sole business. You buy that truck, you have great tax deduction advantages. When you drive down to Florida, you're gonna you can either you do actual expenses based upon business use, or you can use the IRS mileage rates. So for the person like Mark who's going at this full time, actual expenses, depreciating your vehicle, though, that's the way to go. For somebody that's doing this just as their first investment, they have a day job, they're a W-2, and now they're starting to get involved in this. Oftentimes, the best way to do this is just use the standard mileage rate. So when you drive to your property to check on it, to do maintenance, every time you go to your property, you're driving to check on it. So you can't just trust the cleaners.
There's always something to fix, right?
Yeah, there's always something to fix. So when you go down, your drive down is tax deductible. And then when you're there, there are rules on how much you can use a property personally before you have to start allocating your expenses. So if you were to use a property 30% of the time personally, you could only you list 100% of your expenses, but you can only deduct 70. Now, the days that you're there working on the property, doing maintenance, that you're not quote unquote using it as for the enjoyment, those don't count when you're counting the days of personal use. So it's often good to, there's always something with a house that needs to be done. And if you're a handy person, obviously you're there to make those repairs over the course of the week or so that you spend down there.
Absolutely. In fact, that kind of leads me into the other question that we received from someone who emailed me. And they have one short-term rental. They're super excited about it. They want to buy another one. And again, this is not tax advice. This is not financial advice. This is simply a conversation. But while they're looking for their second short-term rental, the mileage and the expenses that go along with that, would that possibly be tax deductible for them?
Yeah, I picked that up as a tax deduction. It varies. So technically, once you've located the property that you're going to buy, then that is an expense for that property. When you're searching for properties, it's not deemed a direct deduction, but it is something that you can roll into the basis.
Gotcha. So it is something to be mindful of when you're looking at an area. If you've solidified yourself in an area, or maybe hyper local to an area, right? You found this section of the Keys you want to be, and that may be, again, talk to your CPA. That may be a tax deduction versus you take a trip to Alabama to visit family, and you want to write that off as a tax deduction. You got to be careful, right?
Right.
Okay. We want to make sure we're clear on the different things. So, and again, if you're active in your real estate and you're using your vehicle for various projects, it becomes an asset. So, absolutely, make sure you're getting that vehicle at 6,005 pounds, as Ron and I discussed in the previous episode. And again, one of the things too, Ron, I want to bring up, because I know I talk about this in my course, and this is one thing that I haven't heard any of these short-term rental gurus talk about. I want to have your input on this. Is I learned early on with starting businesses, because I've had businesses for 25 years, and I started an IT company back in 2000. Built it up from nothing and sold it to a NASDAQ traded company in 2015. So I know how things work. I stayed on board as a senior vice president to that publicly traded company. But one thing I need to stress to people, and again, we go over this in my course at VRB Outstanding, is an exit strategy or an exit plan. And we talked about a 1031 exchange, and we just talked about condos, and that might be the retirement vessel. And I want to, I guess, lay some groundwork with tax planning. You had mentioned meeting quarterly with your clients, but they should talk to you about where they are and where they want to be throughout not only the year, but also long term, because they may, like, for instance, a tax strategy like a 1031, they have a beach rental. It's a beach looking rental, but it's not the house they want to retire in. How they can possibly turn that into their retirement home and defer taxes. So if you can just talk a little bit about long-term tax strategies and exit plans, just briefly, because I know that's something that I'll let him rename nameless, but he's young, and he's thinking of the future, and he wants to retire early, and he wants to stay in Florida, especially South Florida, and he knows what I'm talking about. Um, Give us some insight about some exit strategies and long-term planning with taxes, if you could.
Exit strategy should be something you're thinking about from the very beginning. And I think, yeah, a lot of people are short-sighted. They just want to jump in. So if you're in your 30s or 40s and you get that property in your favorite vacation area, then that's great, and you have time to change. But just like planning for retirement, you need to plan for the exit strategy of your house. And if you're planning on wanting to retire in that former short-term rental, then as Mark indicated, you could start out small, get into it, buy what you can afford. And then as you accumulate wealth, you could do a 1031, roll it into property that you feel like you're going to want to retire in down the road. And then once you decide to take it personally, everything stops, and your basis in that house for tax purposes is whatever the basis was, less, the cost, less all the depreciation over the years. That's going to be your basis now in your personal retirement home. So if you go to sell that at some point because you want to downsize or you decide you want to live somewhere else, then you're gonna incur a significant tax gain. But if you hang on to that until you pass away, then depending on the estate tax rules that exist at that
Mm-hmm.
time, because they change often with every change in administration in Washington, you could end up, your heirs could end up getting a big step up in basis to the fair market value and completely escape any taxes. So,
I love that.
yeah, yeah,
And
you're setting up your kids with a very substantial investment that they can then maybe start to SDR or sell it at no gain because of the step up in basis. So there's a lot of options.
and so this gentleman who asked this question, he actually has several properties, and I convinced him to invest in one of the keys, and he did, and it's going bananas. So he's got several properties, and I talked about exit strategies, and so we discussed how he is considering, it's part of his plan in the next 15 years, 20 years, is maybe even growing his portfolio, but then wrapping all of them up and doing a 1031 to one big retirement home, and
Hmm.
then be able to step up the basis points for the kids when he passes on or hands it over to them. So there's so much opportunity for saving taxes, and unlike being a W-2, right? You've got being a real estate owner, which I don't know the exact number, but I think like only 5% of Americans own more than one home. Something in that, and maybe it's 5 to 8%. But Ron, the benefits of owning multiple homes, especially a rental, there are some tax implications that can save, even if you and your spouse both work full time. There's some great tax implications that can save you money. Isn't that correct?
Oh, for sure. I mean, the way the tax code is structured right now is the standard deduction is so large. If you're just two W-2s, you have your own principal residence and no type of business activity, you're really, it's the reason why a lot of people like that do their returns on TurboTax and don't have a CPA. Maybe they have a financial advisor, but they don't get involved in having a CPA because they can do it themselves. But getting into the short-term rentals, now you've got a real business. Now there are things that you have been doing in the past which were technically were personal. Now that you have this business, well, there's some gray area that you can take deductions on some of your activities that you couldn't as just a W-2 employee.
There's that gray area, and again, we want to make sure we don't cross into anything illegal. But like for instance, I know I've purchased, for instance, a pressure washer that I've used at my short-term rental. I've used at my personal residence too, but
Yeah.
it's one of those things. And also, Ron, one of the things that I always advise people to do is you want to have some kind of storage or shed at your short-term rental. And in some places, maybe it's zoning, maybe it's HOA or something else, you can't have a shed. So one of the things I've done on one of my properties is I got an enclosed trailer that I use as a shed. It's just a shed on wheels. And so that's one thing where I got it right before COVID kind of spiked. And for those of you who follow trailer sales, trailer value's gone up substantially since COVID, mostly due to the parts availability and so forth. But that trailer can be used for other things as well, even though it's my storage mechanism at one of my rentals. So there's definitely some things that can be done. And I want to go on to the next question that came in via chat, actually. And it's, how important is timing my purchase?
It's very important because of the material participation rules. And if you're going to qualify for that, if that's your intent to be able to take full deductions on your property, then it's important to not wait too late in the year. And it's important to know what's going on in your tax picture in the year that you buy something, so that maybe you can offset some of the losses from depreciation against income from other activities. Maybe you're just borrowing money on the equity of your principal residence and rolling it in, or you have enough investment money that you're just going to divert it out of your stock account into buying this property. So in cases like that, the timing is not as important. But if you sell something in order to gain the proceeds to purchase your short-term rental, then timing is important.
So now that you have a real estate office, I guess you're seeing or expecting springtime to be a busy time for sales, because people are planning their year. They've got their new projections and so forth, how they're going to start the year and take advantage of those taxes. And one of the questions too that came in, because this person did not have a CPA, they were concerned. We're recording this in December, which is a little late, but she asked, when should I get a CPA?
Before you buy it. You've got to get a CPA involved before you start making decisions. There are so many nuances to starting any type of business, short-term rentals, no different. And planning is the key. And particularly in the short-term rental market, part of that planning is, what's the high season for the property that you're buying versus the lull in the market. If you're getting a property in South Florida, you better hit the ground running and just keep rolling with it and earn your income. And you wait until a period of time when rentals typically are lower. That's when, if you want to do some upgrades, that's when you do the upgrades.
Yeah, and that's some great advice. And what's interesting with Florida, it's like it's booked year round. And when I had my short-term rental in South Carolina, we would rent until about the end of October, and then we'd rent Thanksgiving week and Christmas week, and then we'd pick up again in March. So we had a couple weeks in November, a couple weeks in December, then we had January, February. So any major repairs, we had those 2 months, and then that was it. March came and it was booked 7 months straight. And what's interesting is we booked a year ahead of time. And right now we've got a market, a recession where people aren't spending as much money. And also we have a supply approaching demand in short-term rentals in some areas more than others. And Ron, I know some people are coming to you for advice for where they should buy and so forth, and they're coming to you with numbers. And that's one of the things I know you offer, because you don't want to get something that is going to be negative. You always want to get something that's positive. But let's talk about the negative if we can. And I hate to do that, but there's going to be some down markets, right? Whenever there's an up market, there's a down market. The great news is that down markets don't last forever, and they're shorter than up markets, right? But is there any advice you can give for people in a down market? Maybe they have a down year. Is there anything that you can shed some light on tax-wise that may help them out?
Well, if you're having a down year, then in theory, you may end up with losses. And as long as it's cash flowing positive, and even if you break even, it's not so bad. But you need to have reserves to prepare for something like that, and you need to um, that if it's a down year, then like Mark said, that's the time to make some upgrades possibly. Maybe the housing market is dropping too, so that could be an opportunity for you to get another short-term rental.
You buy in the lows, not in the apex, right? So one
Right.
of the things I want to make sure you read between Ron's lines there is, you may have a down year, okay? But remember, we're taking advantage of all these expenses, including depreciation. So on paper, for tax purposes, you may be net zero, okay? But you've paid your mortgage if you had one, and you made your other payments. So you're paying off your asset. So it's never really that bad. It's just tax wise, you're showing no income, and so
Right.
we just want to make sure we're clear on that. So Ron, there's one question I purposely saved this towards the end because this is a heavy one. Okay. We talked about depreciation, the bonus depreciation, the accelerated depreciation on vehicles. But give me an idea of what other expenses are deductible? Cell phones, laptops, internet. What can people expect that they can deduct off their taxes? Because again, we never really want to make profit, right? We always want to get as close to break even as possible.
Right. You want a cash flow positive, but have that depreciation get you to zero or less.
Yeah.
Well, as Mark mentioned earlier, if you're buying tools specific for your rental, those are going to be deductible. Your expenses to go visit, of course, all your cleaning services, any repairs and maintenance, all your supplies. It's a good idea to take advantage of when sales occur and you want to buy extra towels and sheets. Marcus talked about that in his course. So the timing of when you spend money, you're still going to get a deduction for it. So if you build up some supplies, it's not a problem. You're still going to get to deduct it when you pay for it.
Yeah. And this is a very dynamic industry. Things change all the time. So again, tax deductions like buying a computer, taking my VRB outstanding course, but even things like your software to run your business, your PMS system, like I use OwnerRez, and your website. Those are all tax deductions. So you shouldn't be afraid to spend a little money to make money because those are valid expenses that are actually going to bring you more money.
Yeah, and with respect to a computer, you need one anyway. So if you for some reason you didn't have one, or you have a really old laptop that needs to be updated, buy it now. You need to update your smartphone for some reason. Uh, STRs, if you're managing it yourself, a good smartphone is really necessary because if you install like an Ecobee thermostat in your house, or camera system outside the house to see people as they're coming in, all of that is going to be deductible, and it makes your life easier.
So, Ron, that's an excellent point because this is a business. This is not a side hustle. And I tell people you can't run your business just on your smartphone. You need to have a smartphone, but you need a laptop as well. You need something you can bring with you, have a full computer. Now we have QuickBooks on it, right? But also be able to do a listing properly on your computer. So again, don't be afraid to spend a little money to make money. You're a professional. This is a real business. This is not selling watches or CDs out of your car. This is a business, and you need to treat it as professionally as such. And speaking of, it's that time of the video where we're going to save you about $600. Our $795 VRBO outstanding course, which in 2023 is going up. We're going to drop that down to the first person who clicks on this code. They're going to get my course, the same exact course that Ron's been part of, for only $199. This is my way of helping you guys to build up your short-term rental through a down economy. Now, we got some great questions from everyone here. If there's any more questions you guys want, pop them down below in the comments. Remember, hit like and subscribe, and we'll see you again next week. VRBO Outstanding.